Hey guys, this is Mr. Oxy. I am in Palm Beach in Florida for a little while longer before I hit the road again, and be spending the weekend in Orlando, which apparently is a fun place to be. Talking about fun, a couple of people said, Mr. Oxy, you should wear your Mr. Oxy hat. So I don't know if this is my Mr. Oxy hat, but I'll just use this one for now and say, okay, it's my Oxy hat, because today's video is specifically about Occidental Petroleum. What we're going to do briefly here is take a look at Morningstar. Now, I often joke and say analyst. Morningstar is one of the analyst companies that I actually follow and appreciate because most of their analysis is good. And while all around us is crashing and Oxy is back down to $22, who would have thunk, right? So we're back down to the warrants exercise price. People have asked me about the warrants as well. What do we do here? The answer, of course, is if you can buy Occidental for less than $22, there's no purpose in exercising your warrants because you can buy it on the market for less. The warrants give you a right to buy Occidental for $22. So ideally, you want to exercise that warrant, whether you want to cash out or if you want to buy and hold when Oxy is way past $22 per share. Anyway, let's take a look. This is a 16-page report, so I'm not going to go through the entire report. Well, I'm kind of going to go through the entire report, but I'm not going to do all 16 pages. Let's take a look here at what Morningstar's equity analyst said as of August 16th, which is obviously just a few days ago. 3-star rating, it's kind of like whatever, you know, whether it's 3 stars, 2 stars, or 4 stars is not too significant a difference. The last price, $24.79. Of course, we already see Oxy this morning at $22. So just because we're a little out of date here, we're already down another 10% from there. The fair value estimate for Morningstar is $37 per share. Market cap, the economic moat is none. Right now, it doesn't have a moat. The uncertainty is extreme. Obviously, we can see that in the way that Occidental stock price reacts to the price of WTI in this particular instance. And the ESG risk rating assessment is kind of a new one because they didn't have this on reports before, not for a long time, but now it's sort of on each one, 2 out of 5. A couple of gaps here that probably are not spending any time or paying too much attention to Oxy low carbon ventures at this moment in time. We look at the price versus fair value, and Morningstar says over the period reflected in the graph here, from looking from left to right, Oxy was borderline overvalued, whereas right now it is significantly undervalued. It's absolutely oversold. You know, I don't make recommendations for people to buy or sell stocks because I have no idea about your personal situation, but there's no question that Occidental is undervalued right now. And if anything, it's probably a buy. So let's read a couple of highlights here. So Oxy has made huge progress on its balance sheet. Let me see if I can get a highlighter here. So after taking a second look at Occidental's second quarter operating and financial results, we have lifted our fair value estimate to $37 per share from $32. The increase primarily reflects a reduced cost of capital assumption. Given how quickly the firm is deleveraging, we no longer think it is appropriate to penalize the firm with an above average cost of debt. You will know for a long time, for at least a year, we were talking about Occidental's wall of debt, actually about 18 months or so. Now the debt ratios, depending on what you measure it again, is pretty much just in line with the industry average, and Occidental is still working hard to bring that long-term debt down more. We think the preoccupation with near-term capital returns has driven investors away from Occidental. The firm is coping with uncomfortable leverage ratios following the ill-timed 2019 acquisition of Anadarko Petroleum, making debt reduction the only prudent use of its excess cash. Well, we kind of know that, right? That's where we are right now. Ill-timed doesn't mean it's a bad acquisition. It just means the timing was terrible. In fact, the timing sucked because within the next year, the futures on WTI actually went negative, which is completely extraordinarily ridiculous. That means it cannot yet compete with better capitalized peers, which have established a trend for capping reinvestment rates and committing to substantial returns to shareholders. The mechanism for doing so varies. Some firms have initiated variable dividends, like Pioneer and Devon, and others are focusing on growing base dividends with the occasional ad hoc special payout. By the way, if I do clear my throat, please forgive me. You can call it Delta if you'd like. People don't like it when I talk about COVID-related stuff. They say I should stick to my area of expertise, but that's where I'm at, right? So, but anyway, all is well. Although Oxy is starting from behind because of its debt load, we think it has more potential for long-term cash generation and returns than any other U.S. exploration and production firm in our coverage. Did you get that? Although Oxy is starting from behind because of its debt load, we think it has more potential for long-term cash generation and returns than any other U.S. exploration and production firm in our coverage, and Morningstar covers a lot of energy and oil and gas stocks. Business strategy and the outlook, we know that they have been divesting, so I'm not going to spend too much time on that. The Anadarko acquisition was announced in May 2019 with an asking price of $57 billion or $76 per Anadarko share, which was paid 78% in cash. Timing, huh? Man, when your timing is off, it can really, really hurt you. The Anadarko deal was a huge undertaking for Oxy, which had itself an enterprise value of $50 billion at the time the deal was announced. How's that, eh? $50 billion, that was Oxy's market cap at the time they announced the deal in May 2019. Now today we have Oxy at around $20 billion. So it's not only half of Oxy, it's less than half of Oxy plus Anadarko plus West plus any other assets that Oxy has that is relatively easy to quantify because it's publicly traded. The cash portion was partly financed with a $10 billion equity investment from Berkshire Hathaway. We know about that one. The coupon, good deal for Berkshire Hathaway. An okay deal for Occidental, assuming WTI prices in the 60s, 70s, 80s or whatever, but not when the futures go negative. That's horrible. Despite these arrangements, the deal left Oxy with significantly higher financial leverage shortly before oil prices collapsed in 2020. Okay, so it's all kind of background stuff. We know this, right? So let's get into this here. What do the bulls say? I'm an Oxy bull, unashamedly so. So I'll just say these three bullets here kind of, for the most part, speak to me anyway. Oxy has a dominant position in the Permian Basin. That's not even questionable, which is the cheapest source of production in the United States and is expected to be a major growth engine in the next few years. Fair. Oxy generates much more cash than it spends. Absolutely, especially now, which means once the balance sheet has been patched up, it can restore its industry-leading payouts to shareholders. Coming soon, but I think we're probably about another 2 years or so away. The low-carbon ventures segment is synergistic with Oxy's chemical business and Oxy's ER portfolio holdings, and expertise give it a natural advantage in carbon capture. So let's be objective and see what the bears say. Although Oxy's Permian wells exhibit very high initial production rates, they also decline very quickly. True. The EOR segment is very capital intensive and is a high cost source of production. True. The Anadarko acquisition has stretched Oxy's balance sheet, making it more difficult for the company to endure weak commodity prices. This last one is absolutely true, but now backdated because that is no longer true as of today. Economic moat, David Mead says, historically Oxy has done a better job of generating returns for shareholders than most upstream oil. Let's see what else is going on here. Here's a peer comparison for you. Oxy's current fair value, according to Morningstar, is $37. Devon, 33, Marathon, 13, and Pioneer, 197. If you look at the last close here, even though it's a few days out of date and energy has crashed since this was published, the upside is very, very attractive if you are in a buying mindset and probably a contrarian, because man, this stuff can be scary sometimes, right? You know, it's like, yeah, sometimes when I chat with you guys, I say it's like one Maserati, two Maseratis, right? So when a stock goes down $10, like Oxy did from $32 to $22, you know, it's $10 times multiplied by however many thousands of shares you have. So I'm not kidding when I say one Maserati, two Maserati. It's like, that's the world we live in. The assessment is fairly valued, undervalued, fairly valued, undervalued. So according to its peers here, if I just scroll back up a little bit, they are basically saying Devon and Pioneer are more undervalued than Oxy at this moment in time. These reviews should be relatively or generally consistent because they're all done by Dave Meat. It's all good. Here's some ratios here. Price to fair value. Some of the critical things for me when I look at the ratios, you can get trapped and stuck in ratios and just do endless spreadsheeting things to death. One of the things I want to look at is the current ratio. Does the current company have enough current assets to meet its current liabilities? Current liabilities generally are 3 months worth of liabilities that have to be met. If the company has 1 or greater as a ratio of current assets to current liabilities, I like it. Oxy is currently at about 1.15 from memory, and Oxy's interest coverage ratio is about 1.5 or something. It's pretty good. Excuse me. Like peers, Oxy adapted to low prices by cutting costs and is now able to generate substantial free cash flow and earn economic profits on incremental dollars it invests, even in a $50 to $60 oil price environment. That's a critical point here, guys, because right now we have WTI at around $63. If I had told you 6 months ago that WTI is going to hit $63, you would have been elated. But because we were at 70, whatever it was, $76, $77 a month ago, suddenly $63 is awful. It is okay. Oxy can adapt to lower prices by cutting costs and is now able to generate substantial free cash flows, even in a $50 to $60 oil price environment. However, if it further delayed the potential for excess returns at the corporate level by entering into a very large and expensive corporate acquisition in 2019, obviously we know about that one. Like most of the E&P firms, Oxy is exposed to a range of potential environmental, social, and governance issues that could hurt its ability to generate stronger returns, right? I have to be, I have to be aware of the fact that a lot of people attach much more value to ESG than what I do, and all strengths to them. Unfortunately, regrettably, for people like me, it can also impact the price of the stock on an ongoing basis. Greenhouse gas emissions are the biggest threat, and these are unavoidable for oil producers. Firms can clean up their operations, blah, 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 blah. Okay. Oxy does have another edge over its peers because it is uniquely positioned to divert CO2 bound for the atmosphere and store it underground. Instead, this advantage stems from its extensive enhanced oil recovery, EOR, operations, a technology that boosts productivity in mature oil fields by injecting CO2 into the reservoir, creating a sink for CO2. It's interesting that Occidental can use trapped and stored CO2 to improve its yield. The other people who use CO2 on a regular basis to improve their yield are people who run grow houses or greenhouses, right? People who grow food, including the food that we eat. They inject CO2 into the greenhouses in order to improve their yield because CO2 is plant food. So not everything about CO2 is bad. Oxy aims to construct a direct air capture plant in the Permian area, which will reduce atmospheric CO2 by 1 million metric tons annually, which would also offset half of Oxy's current emissions. That's quite impressive. Finally, spills are mainly a concern of firms operating offshore. Offshore activity is not the main focus for Oxy, so it's not really applicable. Our primary valuation tool is the net asset value forecast. So when I talked earlier about people spreadsheeting things to death, you can do discounted cash flow analysis, DCFs, you can do asset value forecasts and things like that. You can spend your time keeping yourself busy with all kinds of spreadsheets. At the end of the day, you cannot control the stock price and you cannot control the price of the commodity. So at the end of the day, all your assumptions are going to turn out to be assumptions. And often, unfortunately, most of those assumptions, including mine, will just be wrong. Cash flows from current base production are included with the hyperbolic decline rate assumption. Our valuation also includes a mark-to-market present value of the company's hedging program. We assume WTI prices in 2021 and 2022 will average $66 a barrel. That's kind of where we are right now, respectively. In the same period, natural gas prices are expected to average about $3.60 per 1,000 cubic feet. That's all good. That is where we are right now, so that's fine. Based on this methodology, our fair value estimate is $37 per share. This corresponds to an enterprise value EBITDA multiples, EBITDA, earnings before interest, taxes, depreciation, and amortization. It's one of those fudged GAAP accounting numbers that people like to use. I don't, but I'm not in charge of accounting. This corresponds to enterprise value EBITDA multiples of 6.2 times and 6.3 times. Is very reasonable for 2021, 2022, respectively. Our production forecast for 2021 is 1.17 million barrels of oil equivalent per day, which is above the midpoint of guidance. That's easily achievable. They will do that. That drives 2021 EBITDA to 16 billion, and we expect cash flow per share to reach $13.76 in the same period. Did you get that? That drives 2021 EBITDA of 16 billion, and we expect cash flow per share to reach $13.76 in the same period. Our 2021 estimates for production, EBITDA, and cash flow per share are 1.16 million barrels per day, 17.7 billion, and 15.41 respectively. So I know some of you are going to ask me, what do you think the cash flow is going to be, right? So in the last quarter's earnings, I said between Dr. Yuri Zhang and myself, we kind of agreed the revenue was going to be more than 6 billion for the quarter. And then cash flow, maybe 2 billion or thereabouts. Anyway, we were sort of mostly right. It was okay. Risk and uncertainty, obviously the things that you cannot control, the deteriorating outlook for oil and natural gas prices would pressure the firm's profitability, reduce cash flows, and drive up financial leverage. An increase in federal taxes or revocation of intangible drilling deductions could also affect profitability and reduce our fair value estimates. Finally, as an offshore producer in the United States, Oxy has additional vulnerability. The firm's drilling campaign in the Gulf of Mexico, which you often see on their reports as GOM, requires ongoing approvals from the Department of the Interior. As this entity is controlled by the executive branch of the United States government, it can suspend permitting activity without congressional approval. President Biden is likely to enact legislation withholding future oil and gas permits, which could hurt Oxy's growth in the Gulf. I have never seen anything as inept and completely devoid of intelligence as the administration's decision to ask OPEC to increase their drilling instead of like literally you just put a call into Vicky Holub and say, can you increase your production? She'll say yes. This is all about Vicky. That's because I was talking about her. Analyst Notes archives. Oxy generates 2 billion in free cash in the second quarter. We'll deploy to the balance sheet. Occidental exceeded the high end of second quarter guidance with total output of 1,203 million barrels of oil equivalent per day, which is 5% higher sequentially, but still 14% lower year over year. The beat was attributed to efficiency gains across the portfolio, coupled with better than expected well performance in the primary US onshore regions that Oxy is focusing on. The 2021 budget is unchanged at 2.9 billion, while management lifted the production outlook, albeit nominally. The 0.9% increase in full year guidance strikes us as a little soft, given that second quarter output was 4% higher than our estimate, or the midpoint of guidance. We expect Oxy to hold on to some of the efficiency gains it reported, suggesting upside potential for 2021 production. The firm's financial results also surprised to the upside, with adjusted EBITDA and adjusted earnings per share coming in at 3.3 billion or 32 cents positive, respectively. Remember when the analysts were saying they're expecting a loss and maybe it's a zero. That compares with FactSet's consensus estimates of 3 billion and 2 cents, 2 pennies. The highlighted free cash flow of 2 billion is impressive and will support the ongoing balance sheet strengthening, while it has been an urgent priority since Oxy overreached with the acquisition of Anadarko Petroleum. Oil at $70 a barrel has been just what the doctor ordered. Well, it's not at $70 a barrel anymore. It's at 63, which is perfectly fine. It's okay. In the second quarter, it launched a tender offer of $3.1 billion of outstanding notes. However, it could still take another year or so to bring down the debt to the mid-$20 billion range it targets, which means that returning significant cash to shareholders is probably going to be on hold until then. So, guys, on that note, I'm gonna wrap it up. And I don't want to let me throw my Oxy hat into the air. I don't want to sound too bullish or too optimistic about Oxy, but Oxy will be okay. You just got to kind of hang in there and say to yourself, I invested in Occidental in order to get a return on investment. And if you're not day trading, the current fluctuations in the WTI price and even the price of your favorite commodities do not matter all that much. There's that famous quote from Warren Buffett, whether you like him or not, who once said, you got to be careful buying things that you can't afford, because soon you might be selling some of your assets to pay for the things you couldn't afford. It kind of sums up Occidental's acquisition of Anadarko. But you know what? It's not a bad deal. That was bad timing. Nobody could have foreseen that. So guys, it's a positive video all in all. You got a fair value price in the 30s, and if you go with Morningstar's analyst report, 37. Hang in there. Stay the course. You'll be okay. I'll talk to you soon. Bye-bye.